Now let's look at illustration number 15. ST Limited purchases an option from AT Limited. All right, there are two companies, ST and AT, which is entitling the holder. All right, who is the holder in this case? ST is basically the holder. ST is purchasing an option, so ST is the holder, and AT is the writer of the option. All right, so holder is ST and writer is AT. The holder is entitled to subscribe a fixed number of equity shares of the issuer at a fixed exercise price of rupees 50 per share at any time during a period of next 3 months. All right. So this is basically like an American option. All right. ST Limited has a right. It has a right to purchase a fixed number of shares. We are not given what the number of shares is. Let us say the number of shares is 10,000. All right. Let us say the option contract is for 10,000 equity shares. During the next 3 months, it has a right to purchase 10,000 shares at a price of 50 per share. All right. So if the price is greater than 50, then ST will exercise it. Let us say if the market price is greater than 50, let us say if the market price is 60, then ST will exercise it because it is able to actually purchase the shares at 50 rupees only. It's able to purchase the shares at 50 rupees only while the market price is 60. If the market price is less than 50, then ST will basically lapse the option. It's not going to exercise the option, it will lapse the option. In the market, the shares are available for 40. Why will it actually purchase it at 50 rupees? All right, so it's going to lapse the option. Now over here, remember, right to buy shares is also actually of AT Limited only. Whose shares are we entitled to buy? ST is entitled to buy shares of AT Limited. All right. Usually, in the examples that you might have actually seen in AFM, what you would have seen is there is going to be an entity A and an entity B. A is, let us say, the holder. B is, let us say, the writer, but usually the holder and writer, they enter into an option on Reliance shares or on shares of Infosys or on the shares of Apple. All right, like let's say they enter into an option contract on different underlying. But in this case, what we are actually saying is they are actually entering into an option contract where A has the option to purchase shares of B Limited only. All right, so A and B are entering into an option contract where A has the right to purchase 10,000 shares of B Limited and at an exercise price of 50 per share. At an exercise price of 50 per share. So what will happen is in the next 3 months, if A Limited exercises, what it would do is it would pay 50 per share to B Limited, and B Limited will actually have to issue 10,000 equity shares. All right, A Limited will pay 50 to B Limited. B Limited will actually have to issue its own shares of 10,000. 10,000 own shares will actually be delivered to A Limited. All right. If A Limited does not exercise the option, then neither is A Limited going to pay 50, nor is B Limited going to deliver its own equity shares. All right. So in this case, A and B are entering into an option contract where where ST Limited has an option to purchase the shares of AT Limited only, and AT Limited will basically have an obligation to deliver equity shares. Remember, the holder has a right to buy, the writer has an obligation to sell. The writer has an obligation to deliver, obligation to sell, but not Reliance shares or Infosys shares. It has an obligation to sell its own shares, the shares of AT Limited at any time during the next 3 months. The holder has paid an initial premium of rupees 2 per option. The question is examine whether the financial instrument will be classified as equity. Again, we are going to examine it from the viewpoint of issuer. Issuer over here is basically the writer of the option contract. Issuer over here is basically the writer of the option contract. Now, for derivative instruments, what the standard says is from the viewpoint of issuer, evaluate whether the entity has an obligation to deliver a fixed number of equity shares for a fixed consideration. All right. Will AT Limited receive a fixed amount of consideration and does it have an obligation to deliver a fixed number of equity shares? So for derivative contracts, we are required to see whether the issuer has an obligation to deliver a fixed number of equity shares for a fixed amount of consideration. Does AT Limited have an obligation to deliver a fixed number of equity shares for a fixed amount of consideration? The answer is yes over here because AT Limited has an obligation to deliver 10,000 equity shares at a fixed price of 50 per share. Whatever be the market price of the share in the whatever be the price of the share in the market, AT Limited will be obligated to actually issue 10,000 shares at a consideration of rupees 50 per share. All right. So for derivative contracts, remember option over here is obviously a derivative contract. We are required to see whether the issuer has an obligation to deliver a fixed number of equity shares for a fixed amount of consideration. And this is called as the fixed to fixed test. All right. It's called the fixed to fixed test, a fixed amount of consideration for a fixed number of equity shares. And in this case, the answer to that is yes. And therefore, AT Limited will be classifying this as an equity instrument. All right. AT Limited will classify this derivative. The option will not be classified as a derivative in the books of accounts. It will be classified as an equity in the books of accounts. All right. So what the journal entry on day one over here, if you notice, holder had paid a premium of 2. If holder paid, it means AT would have received a premium of 2 per option. So therefore, the journal entry would have been bank account debit 20,000, 10,000 multiplied by 2 to equity of 20,000 rupees. All right. So the amount of premium that AT Limited would have received will be recorded to equity and it will not be recorded to a derivative financial liability. All right. So in derivative contracts, to evaluate whether the derivative is an equity contract, we are going to see whether the fixed to fixed test is met, which means fixed amount of consideration for a fixed amount of equity shares to be issued. If yes, then it's going to be classified as equity from today itself. All right. We are not going to wait until ST exercise this the option. We will actually be recording the equity directly today itself. So the journal entry will be bank account debit to equity of 20,000 rupees. Now, over here, you might actually say that AT Limited does not necessarily have an obligation. It has an obligation if ST Limited actually exercises. If ST Limited exercises, then AT Limited has an obligation. But if ST Limited it does not exercise, if the option lapses, then AT Limited does not have an obligation. Yes, that is correct. But we are actually not going to see whether the option will be exercised or not. We are only going to actually see, does AT Limited under any situation have an obligation to deliver equity shares? If the answer to that is yes, then we will actually evaluate fixed to fixed test. All right. We're not going to see whether ST Limited will exercise or not. We are actually going to see under any circumstance, does AT Limited have an obligation to deliver fixed number of equity shares? And if the answer to that is yes, then we will be recording this as equity on day one itself. Let us expand this example a bit. All right. Let's actually expand this example a bit. The exercise price, the strike price or exercise price is equal to rupees 50 per share. Let me take case 1. If the market price is, let's say, 60, if the market price is, let us say, rupees 60, what is going to happen is the option will be exercised. All right. ST will basically exercise the option. ST Limited will exercise the option. And since it is exercising the option, ST Limited will pay rupees 50, which is the strike price to A Limited. All right. Therefore, ST will pay only rupees 50. It won't pay the market price. It will pay only rupees 50 to AT Limited. Now, in the books of AT, I'm focusing in the books of AT only because AT Limited is the issuer. So on the date of issuance, in the books of AT Limited, I will be debiting bank by 10,000 shares multiplied by rupees 50 per share. All right, we had originally credited equity by 20,000. We credited equity over here. Actually, although we credited equity, I'm calling this as other equity. All right, for the sake of convenience, I'm calling this as other equity. So I debit other equity by 20,000. Whatever we credited originally, I debit that, which is nothing but 10,000 multiplied by rupees 2, which is 20,000, and I will be crediting equity share capital and share premium. I will be crediting equity share capital, let us say, by 10,000 multiplied by a face value of 10 and the remaining 10,000 multiplied by 42. Why is it 42? Because technically, if you see, I have issued each equity share not for 50 rupees, I issued it for 52 rupees. All right, I collected an upfront premium of 2 rupees. So therefore, I've technically issued each equity share at 52 rupees, and therefore I am going to credit share premium at the rate of 10,000 multiplied by 42. So this is going to be the journal entry at the time of issuance if the market price is rupees 60. If the market price is actually, let us say, rupees 40. Market price is actually equal to rupees 40. What will happen is the option lapses. All right. ST Limited will not exercise the option, and therefore, what we are going to do is in the books of AT Limited, this can be moved from other equity into reserves and surplus. All right. We will debit other equity by 20,000 and credit reserves and surplus by 20,000. All right. This 20,000 or 2 rupees that I collected as an upfront premium, that becomes a part of my profit, but I do not take it to P&L. I will actually take it to reserves and surplus, and then I can obviously use it for other purposes. All right. So whatever 2 rupees I've collected as premium, that becomes my profit, and it's available for me to utilize it for other purposes. All right. So this is basically the continuation of illustration 15 as to what would happen if the option is exercised or if the option is lapsed. All right. Remember over here, we are actually ST and AT are entering into a contract for the purchase of AT Limited shares only. All right. Typically, we have all through in our FM examples, you might have seen where A and B are entering into a contract for Reliance shares or Infosys shares, but over here they're entering into a contract on AT shares only, where AT will actually have an obligation to deliver. ST has a right to buy. It is a call option. It is a right to buy for ST, and for AT, it is an obligation to sell. For the writer, it's an obligation to sell if the holder exercises it. All right. And in case of derivative contracts, we are going to see whether the fixed for fixed test is actually met or not. All right. Fixed amount of consideration for a fixed amount of a fixed number of equity shares. If AT Limited has a obligation to deliver fixed number of equity shares for a fixed amount of consideration, it will be regarded as equity. The logic is exactly the same as what we actually saw earlier. From a holder's perspective, ST Limited is exposed to the variability. If the company's performance actually is great, then ST Limited will actually gain from that. All right. It's going to indirectly gain because ST Limited is able to purchase a share which is rupees worth 60 at only 50, and therefore ST Limited is actually enjoying the gain as a result of company's performance. All right. And therefore, we will be classifying this as equity in the books of AT Limited. All right. We're going to classify this in the books of AT Limited as equity. So with that, we're done with illustration number 15.